The money in your pocket feels real. The numbers in your bank account feel safe. But what if neither is truly yours? What if the institutions that control money wield more power than the governments you vote for? Not with armies or elections, but with something far quieter. A promise, a ledger, a centuries-old illusion most people never notice. Why do unelected central bankers decide the cost of your mortgage, the strength of your currency, and the fate of entire economies? And why are they now preparing to unleash their most powerful invention yet? A form of money that doesn't live in your wallet, but inside a system that can observe every transaction you make. To understand how central banks became more powerful than governments, and why CBDCs may redefine money itself, we need to go back. Back to the moment a small trick became a global system. It starts with a premise so simple it feels invisible. Money is not a thing. It's a story we agree to believe. For centuries, people thought of money as metal, gold, silver, something heavy and real. But the true power of money wasn't in the material itself. It was in the trust people placed in it, the faith that others would accept it. This film traces how the guardians of that faith, central banks, slowly rose from obscure institutions to the quiet rulers of modern society. Not by seizing power, but by filling a vacuum governments couldn't control. We'll uncover how banking began as a convenience, evolved into a necessity, and transformed into a force that could topple empires and resurrect economies. We'll look at how crises, wars, and ambition concentrated power into the hands of technocrats, unelected, often unrecognized, yet capable of altering the course of history with a single interest rate decision. And we'll explore the next chapter, the rise of CBDCs, digital currencies issued not by Silicon Valley but by central banks themselves. A tool that could redefine money, privacy, and power in the 21st century. But to understand where this is heading, we must understand where it began. Because the story of central banks isn't one of conspiracy. It's one of human nature, innovation, and the quiet, relentless pursuit of control. Picture London in the 1600s. The streets are damp, narrow, crowded. Merchants shout prices over the clatter of horse-drawn carts. And behind small wooden doors, goldsmiths sit in dim workshops, shaping gleaming metal into coins, jewelry, and something new. At the time, travelers and merchants faced a constant threat: theft. Carrying gold was dangerous, so people began leaving their precious metals with goldsmiths, receiving in return a paper claim, a receipt. At first, these receipts simply represented gold sitting in a vault. But goldsmiths noticed something extraordinary. Most people never came back for their gold at the same time. The metal just sat there, gathering dust, waiting. And so came the trick: simple, elegant, and world-changing. Goldsmiths began issuing more receipts than they had gold. Not out of greed at first, but efficiency. They loaned these receipts to others and charged interest, confident that only a small fraction of depositors would demand their gold. Money, as we know it, was born out of this illusion. More claims existed than actual metal. A promise backed by faith, not substance. As commerce expanded, so did these paper claims. The goldsmiths became bankers. Governments, desperate for funding wars and empires, turned to them for loans. And the idea spread. The economy could grow far beyond the physical supply of gold. But this system was fragile. A whisper of doubt could spark a panic. A line of people demanding their gold could collapse an entire bank. And when enough banks fell, so did nations. To solve this instability, governments created a new institution, a central bank. Its purpose was simple: act as the lender of last resort, a mighty reservoir of trust, stepping in when everyone else doubted. The Bank of England, established in 1694, became the prototype. It didn't just store gold, it created money, stabilized banks, and in exchange, gained influence over the state. Other countries followed: France, the Netherlands, Germany, and eventually the United States in 1913, with the creation of the Federal Reserve, a system born from smoke-filled rooms, financial panic, and political compromise. Each central bank began with a promise: protect the currency, maintain stability, support the government, but remain independent. But independence cuts both ways. Over time, it meant that the most powerful economic decisions were no longer made in parliaments or congresses, but in quiet boardrooms by unelected technocrats. And that shift, subtle but profound, changed the world forever. To understand how central banks gain such power, we must look at their most potent capability: creating money. Not printing money, that's just the symbol. Creation. When a central bank lowers interest rates, buys government bonds, or expands its balance sheet, it's not moving existing money around. It's generating new money into the system. Imagine the financial system as a vast, interconnected web of promises. Banks lend money they don't physically have. Businesses borrow money that hasn't yet been earned. Governments spend money they haven't yet collected. This web is held together by one entity, the central bank, which acts as the ultimate backstop, the creator of last resort. Picture the central bank balance sheet as a reservoir, capable of flooding the economy with liquidity at will. When crisis strikes, it opens the dam, pouring money into banks, markets, and even corporations. When inflation rises, it begins closing the gate, starving the system of cheap credit. In this way, central banks don't just influence economics, they orchestrate it. They decide the cost of borrowing, the value of savings, the stability of markets, the direction of national economies. When interest rates fall, borrowing accelerates. House prices rise. Stock markets climb. Governments run larger deficits. People feel wealthier, even if little has changed in the real world. When rates rise, the opposite happens. Markets fall. Debt burdens grow heavier. Businesses shrink, and recessions begin. This gives central banks a power few institutions have ever wielded: the ability to create or destroy wealth with a single decision. And unlike elected officials, central bankers do not cycle out every 4 years. Their influence is steady, long-term, and largely unchecked. But this mechanism comes with consequences. Consequences that have shaped centuries of conflict, prosperity, and crisis. When governments discovered that central banks could fund their ambitions, history took a sharp turn. Wars became easier to finance. Instead of raising taxes directly, an unpopular political move, governments borrowed from central banks, creating money that didn't previously exist. Think of World War I. The front was fought with trenches and artillery, but it was financed with bonds, inflation, and the printing presses of central banks. The gold standard, once the anchor of global finance, collapsed under the weight of war debts. Nations printed money to survive. Inflation roared. Savings vanished. In Germany, hyperinflation reached surreal levels. People carried wheelbarrows of banknotes to buy bread. Children played with stacks of useless marks. A loaf of bread cost trillions. Economic collapse paved the way for political extremism. History followed. This pattern repeated: the Great Depression, World War II, the collapse of Bretton Woods in 1971, when the U.S. suspended the dollar's link to gold. Each crisis pushed central banks into new roles, from stabilizers to rescuers, from rescuers to architects, from architects to de facto rulers of monetary reality. By the 2008 financial crisis, central banks had become the world's emergency rooms and construction crews, injecting trillions into failing systems and propping up global markets. By the 2020 pandemic, they had evolved even further, directly buying corporate debt, supporting governments, and engineering stimulus on a scale once unimaginable. The line between state and central bank blurred, but the power of central banks remained intact, often stronger than the governments they supported. And now, a new chapter begins, one that could redefine money itself. Today, we stand at the edge of a transformation not seen since the invention of paper money. CBDCs, central bank digital currencies, are digital versions of national money issued directly by central banks. Not cryptocurrency, not bank deposits, but a new category altogether. To understand the significance, imagine this: every dollar, euro, or yuan could exist not as a bill in your wallet or a balance in a commercial bank, but as a digital token recorded on a centralized ledger controlled by the central bank. In other words, instead of money flowing through private banks, it flows through a single, centralized system. Programmable, traceable, and instantaneous. This offers extraordinary benefits: faster payments, lower transaction costs, universal access, stronger security. But it also raises profound questions. What happens when the same institution that controls the value of money also controls its movement? With CBDCs, central banks could issue stimulus directly to citizens. They could apply negative interest rates to encourage spending. They could block illicit transactions instantly. They could trace every payment, tax in real time, or even program when certain funds can or cannot be spent. Of course, central banks emphasize efficiency, modernization, and financial inclusion. And these benefits are real. But power, once gained, rarely remains idle. In a world where money shifts from physical to digital, from private banks to central authorities, the institution at the center becomes more powerful than ever. And the shift isn't hypothetical. China has already launched its digital yuan. The European Central Bank is developing the digital euro. The US is researching a digital dollar. The same mechanisms that once allowed central banks to influence economies could soon allow them to influence the very behavior of money. So what do we take from all this? Not fear, not cynicism, but awareness. Central banks rose to power not through force but through necessity. They filled gaps governments couldn't manage and stabilized economies when no one else could. Their influence is a reflection of a deeper truth. In modern societies, money is the foundation of trust, and someone must guard that foundation. But as money becomes fully digital, the stakes grow higher. The question is no longer just who prints money, but who programs it. Understanding the history of central banking reveals a simple pattern. Power follows the ability to create and control money. Goldsmiths began the pattern. Banks expanded it. Central banks perfected it. CBDCs may take it further than ever before. The future of money will shape the future of society, and the only way to understand where we're headed is to understand how we got here. History doesn't repeat, it reveals. And the clearer you see the past, the sharper the future becomes. If this journey opened your eyes, make sure to like the video and subscribe. There's much more to uncover, and the next chapter is already unfolding.